Good morning, everybody.
Good morning.
Morning.
Like
Good
that
morning.
song couldn't be more fitting lately with this consumer centric world that we are living in. Um, I know we probably got a lot of Madonna fans out there. Um, so we are going to do some investing talk today. So I thought I would get today started first by saying I, I think, and this is again from what I read when I read these personal finance blogs, that some people get stuck in. I've got to invest so much to the point where they're not looking at, have I gotten myself into a good debt position first? I think the first thing they want to do is I don't think any of the stuff that we're going to talk about today makes sense if you're in a situation where you have any high interest debt. Not that you can't have any debt. um, if you've got some low interest stuff or stuff where you feel like you can make more money with your investments than you can on your debt, then obviously I think investing can make some sense. But I just wanted to kind of put that preface out there. If you're in a position where you've got some high interest debt, we really want to tackle that first, because any progress that you're going to make on the investing side is going to get negated and then some from the high interest debt that you have. So but once you're in a position where debt is under control and you've got some extra money, um, I think the first topic, obviously, we're not going to spend too much time on it today, but as real estate agents, investing in real estate probably makes some sense. So whether you're, going to get yourself your first and live in multifamily or something like that, um, that could make some sense. If you came across an opportunity and you wanted to try and um, do the flipping thing, that could make some sense. Although I will say, if you don't plan on doing the flipping, long term, if you're going to do a lot of it, you might be getting yourself into more of a problem than it's worth if you're going to try and do one, because there's going to be a lot of lessons learned on the first few that are going to really eat into your profits. But if it's something that you think you could see yourself doing long term, or I just want to get the experience so that I can be more educated, for that when I'm talking to other investors that might want to do a flip, then try some stuff like that. And then there obviously are a little bit more passive ways to invest in real estate with REITs. Those are real estate investment trusts. So that's another way, if you believe in the real estate market, to do some investing there. So the next thing that I wanted to tackle, because a lot of people struggle with just this basic concept of pre and post tax investing, and just the thought process, I guess, of how write-offs even work when we use that term, of reducing our income. So I wanted to cover that general topic today. So if we use some round numbers, if you make $100,000 in a calendar year and you have no write-offs or expenses or investments, pre-tax investments, then the government is going to want their taxes on the $100,000. So the whole point of write-offs, expenses, pre-tax investing is to bring that $100,000 down to, let's say, $75,000, so that you're only paying taxes on the $75,000. Right. So every time we can, I feel like some people think, oh, I can just spend that. I'm a real estate agent to write off. It doesn't mean it's free. You still spend the money. It just means you're not going to pay the taxes on it. So I think the easiest way is, maybe to think that you're going to save 25 to 30%, depending on your tax bracket, on that purchase. Right. So if I make 100,000 and then I've got, a little home office expense, I've got some signs that I bought, I spent some money on marketing, and I got my, expenses down to $90,000. Well, now I pay taxes on the 90,000 instead of the 100,000. But just on that basic concept, does anybody have any questions? Is everybody pretty clear on that and how you should be thinking about just write-offs in general? tomorrow we're going to get into some specific write-offs for real estate agents, some specific tax savings, some specific money, just regular expense savings for you guys. But does anybody have any questions on that? Okay, so the next topic will be we can invest also. So it's not an expense for our real estate business, but we can invest money into a couple of different options that we can do pre-tax, and we can reduce our taxes by investing into these vehicles. So there's kind of three core vehicles that you guys should have access to: a traditional IRA, a SEP IRA or a simplified employee pension, and then a health savings account. Okay, so I'm not going to go too into the weeds on each one of these. And I would obviously, anytime you're talking about taxes, you guys got to consult with a tax professional. When you are doing real estate full time, and this is your gig, I highly recommend that you are not doing your own taxes, that you're working with a tax professional that can help make sure that you're taking advantage of all of these opportunities. But for the traditional IRA, 2024 contribution limit is 7,000 and 8,000 for age 50 and older. Right. So if I made 100,000, I can put $7,000 into this traditional IRA account and pay taxes on the $93,000. Is a kind of a simple way to look at that. With the traditional IRA, I will note that if your spouse is covered by an employee retirement plan, your ability to deduct from the traditional IRA contributions is phased out at certain income thresholds based on your tax filing status. Again, that's why you need to be talking to a tax professional. But that's your basic traditional IRA, 7,000 or 8,000 depending on your age. The SEP IRA, it is 25% of your net earnings from self-employment, and that's up to 69,000. That's the SEP IRA. And then health savings accounts. For an individual, 4,150, and for a family, 8,300. There is an additional catch-up over if you're over 55 of $1,000 a year. Right, so let's just say you did your 7,000 of your traditional IRA, and then you did another 4,000 into your HSA. You've now reduced your taxes from 100,000 down to $89,000 that you're going to pay taxes on. And this is all money that, the one went into your retirement account and the other one is going to go to pay for different medical expenses. So just show of hands, how many people are putting money into an HSA? Let's see a quick show of hands. Okay, so not too many people. So definitely something, because this is money that you guys are going to spend anyway, right? So you definitely want to take a look at an HSA. I'm not aware of any situations where you're not going to qualify. So I know there could be limits or something if a spouse is contributing, again, or they're getting an employee match or something like that. But these are things that you guys are going to, I grabbed a couple of the different categories, right? Doctor visits, hospital stays, prescription medication, dental care cleanings, fillings, braces, eye exams, glasses, contact lenses, hearing aids, chiropractic, acupuncture treatments, crutches, wheelchairs, any medical transportation, over-the-counter medications, a lot of women supplies are on here. So there's quite a bit. Stuff specifically you can't would be health club memberships, nutritional supplements, unless they were prescription. But 4,150 and 8,300 as a family, those are good numbers, right? So again, if you just spend the 4,000 on medical expenses and you don't do it through an HSA, you don't get that tax reduction. right? So if I make $100,000 and I spend $4,000 in medical expenses, I still pay taxes on $100,000. Or I make $100,000, I put 4,000 into an HSA, I use the HSA to pay for those expenses, and now I've got $96,000 of income. Right, so you paid taxes on $4,000 less. If you're in a 30% tax bracket, it's a third of that. $1,500. So all this stuff can definitely add up. Anybody, Meg, you raised your hand on it. Anything that you want to comment on it? Have you been doing it for a while? You in a position to talk?
So if full disclosure, it is through my husband's work. But so he enrolls through our healthcare and all that through work. So I don't know that my information is going to be super helpful.
Okay. Yeah, I'm pretty sure you can do it without a spouse that's doing it through that. I think you can do it like on your own. So, but definitely something to look into if you guys aren't taking advantage of it. Let's see if I have any other notes on the HSA. So one of the notes on the HSA that I put down here is only available if the individual is enrolled in a high deductible health plan. So some of you guys are, depending on the health plan that you're on, you may not have access. That's another factor to look at. I think that's all I had down for the HSA. Anybody else have a comment that maybe didn't raise their hand on the HSA that might be able to help somebody on the call? Okay. And then, so those are kind of your pre-tax options. There's a couple other pre-tax investment options that you guys could do, but I don't know that they're going to make much sense for a real estate agent. I think the traditional IRA and the SEP IRA are going to be your best options. Again, for your financial situation, you should talk to your tax accountant. But from everything that I've seen, I think those are going to be your best options. Post-tax, you've got kind of two options, I would say. First is a Roth IRA. There is contribution limits of 7,000 and 8,000, but the 8,000 being for 50 and over. And there are income limits on the Roth IRA. Single filers, 146 to 161,000 is where you start to get phased out from contribution, and then married filing jointly 230 to 240 K is where you would get phased out of contributing there. So anybody doing a Roth? Kirk? Okay. Jen, good. All right. So we've got some people doing some stuff. Good. So I believe we should be trying to, I don't know that we'd want to be doing a Roth if we haven't maxed out all of our pre-tax stuff. So make sure you are, again, talk to your tax consultant, but I'm pretty sure the best way to do all of this stuff is you want to max out all your pre-tax stuff so you can reduce your taxable income down. And then if you've still got money to invest, then you can look at this post-tax stuff. So first one is the Roth IRA. So the benefit there is, yes, you paid taxes on the money, but your earnings are going to grow tax-free. Right? So any earnings on that are going to grow tax-free. So you put $100,000 into this. Over 20 years, it grows to 30, or what did I say, $10,000. If you put 100,000 in, it grows to 300,000. You're not paying taxes on that 200,000 of growth, right? So the next option that we're going to talk about is just a regular brokerage account. We talked about this as one of the three main accounts. So if we make these investments, we put money into a taxable brokerage account, we're using after-tax dollars. And then when you make money, if you put the same 100,000 in there and it grows to 300,000, you're paying taxes on that 200,000. All right, so that's why we want to try and take advantage of that Roth IRA before we're going to do regular investing. Let's just stop there and see what questions might arise. Anybody have any questions on that, on the post-tax stuff? All right, I've got a few more things on the investing side, but we are at the halfway point. So if anybody's got anything pressing on a real estate transaction or something that they learned that they wanted to share, let's make sure we open it up for that. Anybody have anything there? All right, if we don't have anything pressing, we'll continue on the personal finance. So I guess, okay, let's assume, hey, you know what? I do have some money. I haven't been taking advantage of my pre-tax stuff. So I'm going to do my pre-tax. I'm going to max that stuff out. I've still got some money. I'm going to start doing some post-tax stuff. How do I go about it? Right. So there's kind of, I would say, three avenues. There's the do-it-yourself, completely do-it-yourself avenue. There are these robo advisors that are going to be pretty low fee. And they're going to help you to make decisions based on you answering some questions. And then there are financial planners, right? So there's kind of three tiers, if you will. My personal take is a very low involvement from outside, but very also low involvement from myself. I'm personally a do-it-yourselfer, but I am a set it and forget it investor. So everything that I've been able to, read about, consume, et cetera, is that beating the market is extremely difficult. It'd be a full-time job. And for those people that do it full-time, all the people on the street, they don't seem to be successful at it. So I don't know how I'm going to turn around and be successful at it. So if that is the mindset, there are some options where you can do some very, low risk, low touch on your side investments. And so that's what we'll focus on today, because it's what I'm most familiar with. If you want to do the robo advisor stuff, it's probably not going to be much different than what I'm going to talk to you about today. It's probably going to make a lot of the same suggestions, but you're going to pay a little bit of a fee for that. So let's say you have $100,000 invested, a robo advisor might, I don't know, take 0.2 or 0.1, depending on what robo advisor you're doing, of those earnings, which over time is going to add up. And then at the highest level, using a financial planner, it's typically going to be around 1%. So if you've got $100,000 invested in these retirement accounts, you're going to lose $1,000 a year, hoping that they're going to make you more than $1,000 in return. Does anybody have any questions just on do-it-yourself, robo-advisor, financial planner? Kirk?
Yeah, so just throw my input in there. I'll triple down on really making sure everybody has a CPA, and when they talk to their CPA, they really talk about that SEP IRA to offset your taxes. That's been eye-opening since we did it, I don't know, 12, 15 years ago. And just to get the tax liability reduced by so much, it's a straight calculation every single year. Our goal is to, of course, fund our SEP first, then pay our taxes, and we do that quarterly. The next one is we definitely have a Schwab account as well. And our advisor does the exact same thing you're saying, and it's just really life changing, you know, just to see the organization from that. And then the last piece is on the trading. So not a huge trader my whole life, but definitely trying to get into, you know, Nvidia and, you know, the big 10, if you will. But one big one that we've been using is autopilot, which is kind of neat. That's the AI tracked trading. You know, they follow people like Pelosi and some of these, you know, huge traders, and that's been actually pretty impressive. So we're trying to do, you know, trying to be mindful of doing traditional tax reduction, and then this autopilot has been wildly amazing. So definitely suggest looking into that.
Yeah. So when you're doing the do-it-yourself way, right? So here's the things that you've got to watch out for, that as an individual, when you're moving in between stocks, every time you trade a stock, there's going to be a cost to it. And there's also tax liabilities if there are gains, if there are losses, right? So a lot of these kind of set it and forget it plans are going to take care of a lot of that for you. And you know, so when you look at this, when you make these investments into these funds, there are what's called expense ratios, right? So you can invest in a specific stock. You like Apple, you can go buy Apple. The problem is you've got to be checking on Apple every single day to see if, hey, do I still want to hold this or not? And for me, I just don't have time to do that, right? So individual stocks for me are out, and trying. It's a lot of a timing game. So I'm a proponent of what are called index funds. So instead of having one stock, what an index fund does is going to go and buy 20 stocks, 50 stocks, 500 stocks, so that you're getting a little bit of everything. When you invest your $100, they're buying you a little bit of everything, right? So that's what a fund is going to do. They're going to have a bunch of different um, stocks that they're buying. So that's like kind of a fund in general. And then an index fund is going to follow a certain index. So there are S&P 500 index funds, meaning they're going to buy a little bit of every single one of the S&P 500. So if you're doing this for long term and you want to set it and forget it method, investing into one of these funds where you don't have to worry about it going up or down or whatever, somebody's going to be managing that for you. There's a fund manager. You can do that. But then there is a fee for that. So that's that expense ratio where it might be like 0.5, 0.65, 0.75. So again, if you have $100,000 in an account, you're going to lose on 0.5, you're going to lose $500 a year to the managers that are managing that fund. The cheapest funds out there with the cheapest expense ratios are traditionally through Vanguard. So that is, personally where I have chosen to invest in funds. They have like 0.06 for expense ratios, 0.09. So very, very low. And then they do a couple of cool things. They have what are called target date funds, right? So when you think about investing, the earlier you are, or the farther away you are from your retirement, traditionally, the more risk you should be willing to take, because it's going to average out over time. So if I have 30 years until retirement, I don't care what the stock market does tomorrow or the next day or even the next 10 years. I'm putting money in there. I'm letting it grow. I know traditionally the stock market will return on average. I want to say it's 9% and vector this, that, and the other. And they say to consider it like 7.5 is what you should get for a return over time. I don't think there's like if you look over more than a 10-year period, I don't think there's more than a 10-year period where it didn't return at least 7.5. So when you do one of these target dates early on, if you say, all right, I want to retire in 30 years, well, early on, it's going to be very stock heavy, where there's more risk, and very bond deficient. So it's going to be 80% stocks and 20% bonds. And then maybe halfway through, it's 60 and 40. And as you near the end, it's going to be more bond heavy and less with stocks. But the fund manager is doing this for you over time. So it is a true set it and forget it. You're not having to worry about trading stocks and the cost of trading stocks. There are some tax advantages because they're investing into tax-free opportunities for you, right? So they're mindful of that when they set up these funds, and you can get them for any year. You could say, all right, 2045, right? And you put money in there, and every year they're going to rebalance at the end of the year, right? Versus if you're doing individual stocks, you got to be rebalancing every single day. So I think it's the best way to get started is to just do some set it and forget it stuff, because if you're trying to time this, it is very, very difficult to do. And you're going to get stock tips from this guy or that guy. If you start to, follow some of these people that will send you emails on what stocks to invest in, because this thing is hot and that thing's hot. For me, I want to take that long term, put money in there, let it grow over time, let somebody else, who's smarter than me, figure out, kind of what those best opportunities are over the long horizon. So I'm a big fan of these target date funds, a big fan of Vanguard. Obviously, do your own research, but I've done a good amount, and I think they are pretty safe investment if you're looking long term. So anybody have any question? There's a lot here, and we're trying to stay high level, but anybody have any questions on funds or target date funds? So one thing to consider is when if you guys are investing into these different, IRAs or SEP IRAs or the Roth IRA, when you put money in there, you have to make decisions on where you want that money to go, right? You don't just put it in there and somebody else picks for you. So you either got to go robo-advisor, and it's going to ask you a bunch of questions, and then it's going to pick for you. Financial planner, sit down, they will ask you the questions, they will pick for you, right? And from everything that I've read, there are, when you're working with a financial planner, there are incentives for those financial planners to sell certain products. They're going to get, bigger returns. The expense ratios might be higher on some of these things. So that's where you could run into some issues. And that's why I think the safe play is that the Vanguard stuff with the long term, and let them do their thing. They've been a reputable brand for, I think it's since the 50s or 60s. The expense ratios are super low, and it is a true set it and forget it if you want to pick a retirement date type of fund. Where to find a financial planner? Margaret, that's a really good question. I've really struggled with this. I don't. When you look at the returns of these guys on Wall Street, they consistently do not beat the market. So I just have not been able to justify, how do I give these people 1% when here's the data over decades. Very few people have been able to beat the market. So so Jen was just saying a flat rate financial planner. So that's a great point. Why don't we finish up on this point? So not all financial planners go by percentage. There are some companies out there that are built on flat rate. So you might be able to pay 200, 300, 500 bucks or something for a session, and just have them take a look at your overall financial position and make recommendations for you. So I'm glad, Jen, that you jumped in there, because I think the flat rate could be a good option if you're just looking for an overall view. And I'm sure there's some good financial planners out there, right? Just like with real estate, there's some people that don't know what they're doing, and some people who are probably worth their weight in gold. How to find those people that are worth their weight in gold, I don't know. So I don't know if anybody wants to comment on that. So Kirk.
Yeah, I'll throw it out there. We actually just changed from Northwestern to Schwab, and actually a private wealth manager from Pam. She's usually on the call here. And for us, we had been with our financial advisor for probably 7 years, and it was, I think, I agree from what you said. It was from our new consultation. Obviously, a lot of the stuff that we had was good for us, but it was also all of their own Northwestern products. So even though we were doing okay, the fees were a little bit high. So just like anything, right? Checking your insurance and checking your, mortgage every couple of years. We talked about balance transfers on credit cards the other day. So we did. We really were overdue for a full, checkup. And going to our new guy Tony here locally in Sarasota, felt great, obviously because he's local. But we did an interview with him, and he was just completely different of what we experienced before from a bigger, financial trader that was very hands off, and here's the products that you have, and you can look at it online, to Tony, who is fully involved, wants to know everything that you guys are, the goals, of course, and then really sets it up. And then the thing that I love, of course, the most is very diversified, and it's a 1% charge. And he's really actively managing it. I've never seen so much communication positively of, future goals, and really kind of what I was looking for in my past advisor. So I think that's just like an agent, right? You got to interview and like the person, like what they're saying, like their techniques, like their style, and then does it match your financial goals? So that was a big one for us this year. Thanks, Pam.
Oh, there she is. All right, guys. Well, look, I mean, we are just scratching the surface, but it's hard to earn the dollar, right? So if we're going to spend the time and energy to earn the money, I want to make sure that you guys are doing the best that you can to invest it smartly. Let's not pay the government if we don't have to, and then let's invest whatever we have left as smart as possible and keep as much of it in our pockets. So. Hopefully there was a couple of things there that at least you can take off and now go and run with, and maybe do some of your own research. As I've said all week, if you have any personal questions that you wanted to reach out and just kind of get my 2 cents, I'm happy to chat with you about it. If you learn anything as you're doing your research, absolutely, bring it back to this group. Hey, I was doing some research here. We were talking about this the other day. I just wanted to share this. So have yourselves a great Thursday, and then we're going to finish up tomorrow with real estate specific finances. So I'm excited for that. I got a bunch of stuff to share with you guys, and then hopefully that's going to be a lot of you guys contributing as well with, hey, I'm doing this, I'm doing that, saving me a couple of bucks here or there. So have a great Thursday, and we'll talk to you guys again in the morning.
Thank you. Have a good day.
Take care, guys.
Thanks, Steve.